using a self-managed super fund is definitely, a way to beat the tax system. Once you retire, all the rental income is tax-free and the capital gains are tax-free. Having more control, you've got the flexibility and broader investment opportunities.
So I'm here with Selvin Cowan. He's one of Melbourne's top accountants from the point of view of setting up self-managed super funds and also helping your business or your company to actually pay less tax and all aspects of accounting. But today we want to focus specifically on how to run and manage self-managed super funds, and especially when it comes to relating to investing in properties.
The big advantage is that you've got more control.
Yeah.
Right. So with having more control, you've got the flexibility and broader investment opportunities. Many people today buy real estate in self-managed super funds because they've got more faith in real estate than in other classes of assets. I'm not saying which one's right or wrong, but a lot of people believe in real estate because of the way they've maybe bought a house previously or an investment property and they've seen the growth. They now want to use their investment in their superannuation in a similar way. If an individual's earning, let's say, $200,000, they'll be paying 47% tax, whereas on the rental income or the investment income, whereas in a superannuation fund, at the level you're talking about, the tax is only 15%.
Right.
Similarly with capital gains tax, the maximum capital gains tax rate that an individual has to pay is 23%. In a superannuation fund, it's 10%.
Oh, so
now, the cherry on the top of all of that is once you retire, all the rental income is tax-free and the capital gains are tax-free.
Yeah, okay.
At the level you're talking about. There are other complicating factors, but generally that's the situation.
Yeah, okay. And what types of properties can self-managed super fund invest in? And what are the strict rules and restrictions?
Okay. Self-managed super fund, you can invest in any kind of property. You cannot live, as a member, you cannot live in a residential property. You can purchase a commercial property and operate your business out of those premises.
Yep.
The real restriction is you cannot benefit from a residential property. That's the critical yourself. The member cannot benefit from a residential property.
Can an SMSF invest in high yield strategies such as rooming houses, co-living, or properties that give you?
Absolutely.
And that'd be more beneficial because you're getting income, positive income, so you actually can
So there's
cover
enough
those
money to cover the
liabilities.
pension.
Yeah, the pension.
Pension liability, correct.
Okay. Okay, so can you explain the step-by-step process for setting up a self-managed super fund and preparing it to buy a property? How does that work? Okay,
so setting up a self-managed super fund is just like having a trust. It's a legal document. Again, name and address, and that's really all you need.
Okay.
We get a document from a lawyer. We make application to the tax office for to be a complying super fund. And once that's set up, the individual opens a bank account. Once that's set up, the individual contacts their industry superannuation fund and rolls the money into their self-managed super fund bank account.
Okay.
Again, there are considerations that have to be made, and they should consult a financial planner. The reason for that is often in industry funds, there's a life insurance component. Yes. And we would not want these people to lose their life insurance.
Okay.
So that's a big consideration before they decide
so you might
to
have
roll
to leave some money.
You may have to leave $5,000 in the industry fund. But once the money's in the bank, you can then go and source a property. And so long as the bank approves of it, because obviously we don't do any of that work, the bank approves of that property,
yes,
it can be done through the superannuation fund.
Okay.
The other big advantage I haven't spoken about is the asset protection. For somebody that's involved in business that possibly has the potential to be sued for whatever reason, or a business to go into liquidation, or the individual to go bankrupt, superannuation and assets in the superannuation offer a fantastic opportunity to protect the asset.
Protection. Yeah. Okay, I didn't think about that. Okay. Yeah. And can you tell us basically what are the ongoing costs and compliance requirements and inside the super fund?
Look, that varies. The documentation, again, the individual doesn't need to worry about,
Yep.
because we would
You
do
handle
that for
it.
them. But they do need to be aware of the ongoing costs. Every year, the superannuation fund has to be audited by an independent auditor. Super fund has to prepare annual financial statements. In an industry fund, each member gets a member's statement at the end of the year because all the money's in one big pool.
Yep.
It's exactly the same in a self-managed superannuation fund. Each member needs to get a member statement. There's annual financial statements, there's a tax return, and there's an audit report.
So, but what does it cost? Like, what would you
Okay,
guys charge?
I would say
Approximate.
I would say that the cost starts at about $2,000 a year.
Okay.
But if someone's got $200,000 or $300,000 in their superannuation fund, the cost will not be that much more than an industry fund.
So it's virtually the same, but potentially
But the benefits are far greater.
Yeah,
the
far
benefits
greater.
are far greater.
Yeah, okay. That's...
So long as the individual understands this is an investment vehicle that they have to be diligent managing, they have to be diligent with the property they buy. It's not for those people that just want a set and forget thing where they just contribute $100,000 or $200,000 to an industry fund where they're trustees that manage it.
Yeah. But I mean, we talked about this a while ago. You actually demonstrated what an advantage is to invest in property, where you're getting returns of 25% of you on your money to 50% of your money. So
yeah, when you factor in the capital growth, absolutely.
Yeah, it's
you know, and if you look at the value general of Victoria statistics going back probably 80 years, it's happened every 10 or 12 years. Why should it stop happening?
Yeah, that the properties double and your return is way better than in a fund or something. Okay, yeah. So how does the tax work inside a super fund, both the accumulation phase and also then once you have the pension phase, because it changes?
Okay, so accumulation phase, the income is taxed at 15%.
Yep.
Until you meet what's called a condition of release. You cannot draw any money out of the fund. It's got to be reinvested. And so we do a tax return. The tax rate's 15%. Your money's reinvested in the fund. And if you can imagine reinvesting 85% of what you earn after the 15% tax compared to reinvesting 53% in your own name after 47% tax, it's miles apart. You're way ahead.
And once you're in the pension phase, what happens?
Once you're in the pension phase, everything's tax-free.
Yeah, like I've just made $100,000 in 7 months and there's no tax.
Correct.
It's in my super
Correct.
fund.
And you can draw that money out of the super fund tax-free as well.
Okay, fantastic. So what rules apply for renovations, developments, or improvements inside of a super fund?
Okay, that's a very, very good question, Peter. If you've got a borrowing in the self-managed super fund, like you've borrowed to buy this property, you cannot renovate or improve the property. Obviously, you've got to pay for maintenance.
Right.
You know, but you cannot improve the property.
So you've got to buy properties that are
completed property.
Or new, yeah.
Correct.
Okay.
You can't buy a piece of land. In a super fund, you can buy a piece of land and you can build a property, a building on it.
Yes.
But you cannot have a borrowing to do that.
You can't borrow for it.
You can't borrow to do that.
Okay. There is ways that people that put into a one-part contract that can then potentially do that inside of a
That's right. That's right.
Yep. But you got to pay for that.
Correct.
Okay. Is there any risks of borrowing through super fund that people overlook, or is there?
No, in fact, there's less risk because we recommend you don't borrow more than 60%.
Okay, so you got
so
less
there's even
leverage.
That's even less risk.
So you're better off. Okay. Can an investor transfer an existing property they already own into their super fund?
That's a good question. The only thing that an investor can transfer into a super fund is what's called business real property.
Yes.
So that's like a commercial property.
Not residential.
Not residential.
Okay, or rooming.
Correct.
Okay. What are some of the biggest mistakes and things that people do in their super fund that's an absolute no-no that could actually cost them fines, even jail time? What are some of the big no-nos that in super
the big one is to draw money out of their superannuation fund before they meet a condition of release. People get into trouble financially and they decide, we've got an extra $10,000 in the fund, we'll just take it out. That's an absolute no-no.
Okay, that means before they're like 67 or whatever the age is.
Before retirement, correct.
Okay, so you can't take the money out.
That's the biggest thing. And then from an investment and wealth creation point of view, people have to realize this is a long-term plan. Peter, let me tell you something. I've been doing this for 41 years. The quickest way to make money, slowly.
Yeah.
And people need to realize it's a long-term play, right? You don't go buy the property and decide in 6 months' time you want to sell it.
Yeah.
You make a decision, you keep it,
Yeah.
you build up your wealth, and you buy another property, and you do the same thing.
Inside your super fund.
Inside the super fund.
Okay. So what are some of the other no-nos in the super fund?
Those are
the
particularly the ones. You cannot live in the residential property.
Yep.
You cannot draw any money out that's been put into the fund. And you know, those are really the main compliance issues. Another important thing I should add is that you should not change advisors regularly. The longer you stay with an advisor, the better benefit you're going to get. Because we've had clients that change accountants every 2 or 3 years. There's no trail of information. They get into trouble. They don't know what's happened. Our most successful clients have stayed with us for 20 or 30 years. Yeah. The most common mistakes are not listening to professional advice and not meeting the compliance requirements. Because if you don't meet the compliance requirements, the penalty is outrageous.
Okay, so you've got to be careful about it. But you handle all that.
And as long as people understand that they have to take professional advice and comply with that professional advice. The other thing to remember is that if you accumulate too much property in a self-managed super fund, and you then go on the pension, there's a minimum pension that you have to draw, and you've got to make sure there's liquidity there. So it's very dangerous to go and buy a negative geared property in a self-managed super fund. You have to find a positive geared property, or not take a loan more than about 60% of the value of the property.
Fantastic.
Balance basis, you would not set up a self-managed super fund today if you've got less than, say, $200,000 invested in super, which a lot of people have. You know, from sort of 20 or 30 years work, they could quite easily have accumulated $200,000. There's no question it's beneficial from a tax point of view, from a wealth creation point of view, from an asset protection point of view. It ticks all the boxes. You know, I don't know about real estate. I can't tell you which property to buy. But if you're satisfied that the property you're buying is the right kind of property for your risk profile, using a self-managed super fund is definitely, you know, a way to beat the tax system.
Good day. If you're looking to invest in a high-income property in the next 3 to 12 months, and whether that's buying an existing property, building a new one from existing plans, or developing land you may already own, then my team and I at Sun Property Institute would love to help you. What we're offering is a free one-on-one strategy session where we'll map out exactly where you are now, right, and where you want to be, and outline the best possible high return and capital growth property options to help you get there faster. Some of the things we'll walk you through is like which property types and strategies are best for income, tax benefits, capital growth, paying your mortgage faster, the best cities, suburbs, areas for future capital growth and returns, and how you can build a property portfolio that could retire you within 10 to 15 years, starting from as little as $70,000 investment. Now, just go to www.Sun Property Institute to book that session, and just click the button on that website to get your free strategy session, or there's a link near this video. If there's a link there, then just click that link. And look at our website. You can also get a copy of a download of some of the books you can see behind me that I have written on property investing, and they're also there on our website. Now, you can take all that information and look, you can run with it and do it all on your own. Or if you like what you see and there is a fit between us, then we can work together with you to help you reach your goals. And either way, you know, you'll learn how to invest smarter with less risk and build your financial freedom with more confidence. So book that call now and book yourself in that session. And either way, best of investing success.